Hello everyone, and certainly a lot of things to think about and cross a bridge on these days. I guess what's most important on the day is the price action moving into New York tonight, into Europe and into New York tonight, is a little concerning. It's not quite, we can be sure, a top has been seen in equities, but there are warning signs that that is the case. So I think it's really on the day, the short-term movement is a little bit flip a coin, but overall you'd have to say there has been a tremendous rally in stock prices, and it is due for a correction. So far we've just seen consolidation for a couple of days now. Even though the slight new highs made, it's really been consolidation for a couple of days. That's the US market. The Australian market's been a little bit the reverse of that. Sideways consolidation, but slight new lows being made, and then recovering again. We saw extraordinary activity from the Reserve Bank today, suggesting that they are under a lot of stress and they're finally feeling it. They seem to be talking a lot about the housing market and the high housing market prices. You couldn't be more late to the party, could you, than that? It's been self-evident for a year now that house prices were skyrocketing on the back of low interest rates. And they think they can adjust for the housing bubble in other ways. It's as if they're saying there could be a housing bubble in the future. No, there is one now. So the question is, does Australia have a soft landing or a hard landing on that? Clearly, prices are going to continue to move higher for the foreseeable future, but there are early signs, and a lot of people in the real estate industry starting to notice there are those early indications that things could just be starting to soften a little bit. And that's a major issue for the country. And I've talked about China and the US this week in terms of their property markets. Australia's property market is a lot stronger, a lot higher quality, particularly against the United States, quality build of average housing in Australia, which gives an innate value there that perhaps doesn't exist in all regions of the United States. Sorry, USA, but that is true. So our strict building regulations do provide a lot of strength, underlying strength, sorry the pun, to the Australian property market. But the RBA today went and bought $1 billion worth of 3-year bond yields to try and keep the yield down to its own forward guidance on where yields would be. But that is massive market intervention that is entirely inappropriate. It's really more in keeping with the idea that whatever they say is what will happen, and it's a complete change in Reserve Bank behaviour in Australia with this current board, because they seem to be stepping away from any role for the free market whatsoever in deciding anything. All they seem to think is that they have to keep rates low because rates are low in the US, but we've got an entirely different economy on a different path in a different part of the cycle, and it just doesn't make any sense at all. And inflation is going to rise, and we are going to have asset prices exceed their real value purely because of what the Reserve Bank has done. It is becoming a crisis situation. As I've noted this week, the OECD has already recommended and taken the rather unusual step of recommending that there be a full review of the Reserve Bank given its performance in recent years, and that review include the board and the bank's charter. That's how badly performing our central bank is on the world stage relative to other central banks, and yet in Australia we still say very little. We need to have that debate. And the actions of the Reserve Bank of Australia today really just highlight that there's something desperate going on within that organisation. So I think the stage is now set, given today's events in the next 1 to 2 to 3 weeks, for some political decisions to be made by the Treasurer in terms of a review. If that isn't forthcoming, I think that would really be letting the Australian people down. We do deserve a capable and reasonable central bank. So stock market prices, I tend to favour the downside, but that's my inbuilt bias at the moment, because I see the economic fundamentals as being nowhere near what either Wall Street or Macquarie Street in Sydney, William Street in Melbourne think they are, in terms of this idea that we're going to have this massive economic recovery, which the Treasurer has certainly talked up, but it just isn't the same platform from which Australia opening up again. We're not launching off the same platform as last time, so we won't get the same results as last time. On the currency front, the Australian dollar does look to be in trouble. Oil's had a bit of a reversal, keep an eye on that. Gold continues to look very firm. I do like gold. I've said it before, I say it nearly every day. I think I say it every day. I do like steady accumulation of gold. The US dollar looks like it wants to firm again, but as I said yesterday, the momentum has been very much towards the euro and sterling of late. The Australian dollar's price action is suggesting there is immediate rejection from that high just seen, and I would use that high as the important pivot point near to medium term now for the Australian dollar. On the day, it could soften a little bit further from what it already has. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.